Hello, my dear students, and welcome back. I know. Exams are so close, and that pressure is building up, right? But please, don't you worry one bit. We are going to tackle this together. Today, we're going to dive into a chapter that seems a bit scary, but is actually super simple. Dissolution of a partnership firm. Look, I get it. This chapter has all these accounts, all these journal entries. It can feel a little bit overwhelming. But trust me on this, okay? By the time we're done with this quick session, you're going to find it so easy. You'll be walking into that exam hall aiming for full marks on this question, I promise. So what do you say? Ready to make dissolution your new favorite chapter? Yes? Awesome. Cello, let's get started. All right, first things first, let's tackle the one thing that confuses almost everyone. And you know what? It's a favorite question for the examiners too. So what is the big difference between dissolution of partnership and dissolution of a firm? They sound almost the same, but trust me, they are completely different things. Okay, look at it this way. Dissolution of partnership is it's like changing the players in a cricket team. One player retires, a new one comes in. But the team keeps playing the match, right? The business continues. But dissolution of the firm, that's like the match ending. Game over. The entire business shuts down for good. We sell everything, pay off everyone, and close the books forever. And that is what this chapter is all about. So to handle this whole shutdown process, we need a special tool. In fact, there's one hero account that's going to help us solve pretty much every single problem in this chapter. And its name is the realization account. So what is this realization account? Just think of it like the final scorecard of the business. You know, after the whole match is over, you look at the scorecard to see who won or lost. It's exactly that. We open this special, temporary account only at the end to figure out one simple thing. Did we make a profit or a loss by selling everything off and paying all our bills? That's it. Super simple, right? Okay, let's break it down. An account has two sides, right? Debit and credit. The debit side of the realization account is, let's call it the stuff going outside. We list all the assets we need to sell. Land, machines, stock, you name it. Oh, and sundry debtors, which is just a fancy name for the money our customers owe us. A very important point, listen carefully. You always list debtors at their full value, okay? We also put any payments we make on this side, like dissolution expenses or paying off a liability. And the credit side? Well, that's the stuff coming inside, or the what we owe side. Here, we list all our outside debts, like money we owe to suppliers, that's sundry creditors, or a bank loan. And of course, the most important thing, all the money that we get from selling our assets, it comes right here on the credit side. So think of it this way. Credit side is for what we owe and what we get. All right, enough theory. Theory is good, but you get marks for solving the actual problems, right? So let's do just that. We're going to take a classic exam-style question, illustration 1 from your textbook, and solve it together, step by step. You'll see it's really not that hard at all. So here it is, the balance sheet for Supriya and Monica's firm. They've decided it's time to close the business. We've got their assets on one side and their liabilities and capital on the other. Our mission? To help them close all the books properly. Okay, step 1. It's super simple. We're just going to pick up all the assets, everything except cash and bank, and move them to the debit side of our realization account. So stock, sundry debtors, fixed assets, they all go there. Remember the golden rule, cash and bank balance never goes into the realization account. Got it? Great, that was easy. Step 2 is just the opposite. We look at the liabilities side and we pick up all the external liabilities. Now, what does external mean? It means money we owe to outsiders, not the partners themselves. In this question, that's just the sundry creditors. So we move them over to the credit side. See? It's just a transfer game. Now, the fun part, selling stuff. The question says we sold the stock for 7,000 rupees and the fixed assets for 42,000. And the debtors? Well, they paid us, but we gave them a small 5% discount. So if you add all that cash up, what do we get? A grand total of 69,425 rupees coming into the business. So we've got all this cash. Where does it go? Remember our rule for the realization account? Stuff coming in goes on the credit side. So we'll record this amount on the credit side and we'll write by bank account next to it. Easy peasy. Okay, money came in, now money has to go out. We have to pay our bills, right? We paid the creditors the full 48,000 rupees they were owed, and there were some expenses for this whole closing down process, about 1,500 rupees. So where does this go? Yep, you guessed it, money going out goes on the debit side.
And that's it. Our realization account is done. Now for the moment of truth. We total up the credit side, which is bigger. Then we total up the debit side and subtract it. The difference, the balancing figure, is our profit. And in this case, it's a profit of 2,925 rupees. And whose money is that? It belongs to our partners, Supriya and Monica.
Okay, finding the profit was a huge win, but we're not quite at the finish line. The final step is to settle everyone's accounts. We need to pay the partners what's left and officially, finally, close the books. Now, you can't just pay whoever you want. There's an official order, a priority list, according to the law. Number 1, you always pay the outsiders first, your creditors, your bank loans. Number 2, if any partner gave a loan to the firm, you pay that back. Number 3, you return the partner's capital. And then, if there's any money still left, that's the final profit to be shared. All right, we are almost done. But before you go, I want to give you some super important last-minute exam tips. These are the little things that can save you from making silly mistakes when it really matters. So here's a quick pop quiz for you. Are you paying attention? In the balance sheet we saw, there was a general reserve of 13,500 rupees. Tell me, did we put that into the realization account? Yes or no? Think about it. The answer is a huge, massive no. And please remember this. This is a classic trick question. Things like general reserve or profit and loss balance, that's the partner's own money that they've saved up. It doesn't belong in the realization account. It goes directly to their capital accounts. It's their money. Don't let the examiner trick you with this one. Look, to solve these big problems without getting confused, you just need a plan. So here's your foolproof 4-step checklist. 1. Make the realization account. 2. Settle any partner's loan accounts. 3. Prepare the partner's capital accounts. And 4. Prepare the final bank or cash account. Just follow these 4 steps in order every single time, and you'll never go wrong. And for my final, most important tip, a little magic trick to know if your answer is 100% correct. Your final bank account, it has to tally. The debit side total and the credit side total must be exactly the same. If they match and the final balance is 0, you can walk out of that exam hall knowing you nailed it. It's the ultimate check. Wow, we've covered a lot, haven't we? You now know exactly how to close down a firm's books. But here's a little something to think about for next time. What if a partner becomes insolvent? Goes bankrupt, and just can't pay what they owe the firm? Something to ponder. But for now, just focus on what we've learned today. Revise it well, stay confident, and go rock those exams. All the very, very best, my dear students.